Good morning, ladies and gentlemen. Today we shall be studying about the classes of insurance. Previously, we've been looking at different terms used in insurance, and for today, we shall go directly to the classes or maybe categories of insurance. Now, insurance is usually categorized into two. Number one is usually life assurance, which is called life assurance because it usually assure of life to maybe other people upon the death of the assured. And apart from life assurance, we usually also have general insurance, which covers other things apart from life. So for this lesson, we shall emphasize on life assurance. So life assurance usually covers the risk of death. That is, if assured dies, then his family or maybe those people, the nominees or the beneficiaries, those people whom he include as the beneficiaries are usually compensated. And the life assurance also covers the risk of incapacitation. That is, if the assured maybe get injured or involved in an accident, then there is some amount of money which the assured is given. Now, that is life assurance, and I've said that it covers the risk of death, and maybe if that person is incapacitated, maybe if he is injured, maybe some of his parts of the body has been uh, tortured or whichever thing, then that individual is usually being given certain amount of money. So life assurance also is categorized into different categories, and so we have types of life assurance. And for types of life assurance, the first one is usually term insurance or term assurance. In term assurance or term insurance is a type of insurance or type of life insurance that provides protection within a specified period of time. That is, if in case the holder dies within that period of time, then he is being given compensation, and that compensation goes to his or her family members. I mean, in case the person dies, then the beneficiaries are given certain amount of money. They are compensated upon the death of the assured or the insured person. And still, under term insurance, it articulates that in case that person doesn't die, then there is no compensation. It usually happens when maybe you are under certain task. Let's say, for example, you are a member of KDF, you are going for a certain mission. You can take term insurance within that period when you are going, your life is in a very in a state of danger. Or maybe those people who are working in companies like Kenya Power, the electricians there, in case they are thinking that their life is in danger, that they can be electrocuted, then such individuals can take term insurance, such that in case they die within that time when their life is at risk, then their families shall be compensated, and in case they don't die, then there will be no compensation. So that is the first category of life assurance, which is term assurance. The second type of life assurance which we shall study is called whole life assurance. And for whole life assurance, this is a type of policy which requires the assured to pay the premium throughout his life, that is, until he dies. And in case he dies when he is still under the assurance policy, then his or her beneficiaries shall be given compensation. So for whole life assurance, it is being paid until that person dies, and in case he die, then the family members or maybe the friends, anybody who is listed as a beneficiary in the policy is being given the compensation. The third type of life assurance is called endowment insurance. And in an endowment, that is ENDOWMENT, endowment insurance. In endowment insurance, the assured is required to pay regular amount of premium for a specific period of time. The sum assured is paid at maturity. So for endowment is almost similar to term insurance, but here that the insured is supposed to pay certain amount of money until certain period of time, and when that time expires, then he is being compensated because he has not died. It is different from term assurance, because term assurance is where when after maturity of that period, there is no compensation. But in case you die, in case of a death risk before that period ends, then your beneficiaries and compensation. But for endowment, there is it is almost similar to the term assurance, but in case that person doesn't die until that time, the maturity, then there is compensation. He is being given a certain amount of money. I mean, the assured is paying some amount of money, let's say for maybe 3 months. Let's say, for example, if someone is employed by KDF and he has gone for a mission of 6 months, so he's supposed to pay certain amount of money for that 6 months. If he die within the 6 months, the family is being given compensation. And if he doesn't die within 6 months, then he is being compensated. It's being given some amount of money because he has not died within the speculated period. So that is endowment insurance. Apart from that, there is other types of life insurance, but I want you to pause the video and write the differences between whole life insurance or whole life assurance and endowment insurance. You're supposed to take at least 10 minutes to draw the table which is in the textbook. I will highlight the page on through WhatsApp. So you will watch after getting to this point, check on, you can ask a question from the WhatsApp where exactly there is differences between whole life insurance and endowment insurance. The time limit for drawing that table is 10 minutes. Then we proceed. Now I believe the 10 minutes period is over and you paused and wrote the table, and now we can proceed with other types of life assurance. So another type of life assurance is called annuities, and in annuities the policy which is called annuities is ANNUITIES, and in this type of policy, it requires the assured, who is referred to as annuitant, to pay a certain amount of money to the insurer. In return, the insurer agrees to pay the annuitant a specified amount of money every year. So even if you check from the dictionary, you'll find that annuity comes from the word annual, which means year. So the insured has to pay some amount of money, and there is a compensation after each and every year in case the insured doesn't die. But in case he die, then the beneficiaries are given compensation. Now we are almost done with the different types of life assurance, and we want to check on the last type of life insurance or life assurance, which each and every person is conversant with, and that is statutory. This particular type of insurance, that is the last one, is called statutory scheme. The statutory scheme is what each and every individual might have to maybe knows about. It is offered by government, aimed at providing certain welfare to the members of that scheme. So this one is a scheme. It is something which is spread through many individuals. It includes things like services like NSSF, that is national. There is NHIF first. There is National Health Insurance Fund, and NSSF. NSSF is usually being paid by government employees within a specific period of time, of course, until one retires from job, such that in case after he has retired, then he'll be given some amount of money to ensure that his well-being will be fine immediately after retirement. But for NHIF, it is usually being paid by maybe individuals. It can be even people who are employed by government, or unemployed people employed by private sectors, and also the unemployed individuals. So in NHIF, you'll be required to do what? To pay a certain amount of money, of which the minimum one for the unemployed is usually 500 shillings. Then in case you fell sick for NHIF, you'll be treated by in any hospital, maybe any public hospital will accept to treat you or pay certain amount of money. It is sometimes not all amount of money is paid. Not sometimes they don't clear all the money. But for NSSF, there is certain amount of money which government retirees are usually being given. Let's say, for example, 5,000, 7,000, based on the particular type of work you are doing. Through with different types of life insurance, but I want us to go back and rewind one after another. We talked about term insurance, which we said that it provides protection over a specific period of time. Someone might just try, maybe if a person feels like his life is at risk and he can die, he can take term insurance, and if he doesn't die, he's not being compensated, and his beneficiaries doesn't earn anything. And in case he die, then there will be compensation to the beneficiaries. Whole life insurance or assurance, a person needs to pay certain amount of money until he dies. If he doesn't die, but at the end of the day, a person has to die. So upon his death, then the beneficiaries shall earn the compensation. Then endowment, I said that it is almost the same as term insurance. And in that note, in case a person doesn't die within a specific period of time, then he's being given some compensation. And if he die, then the family or maybe the beneficiaries will earn the compensation. Annuities, that is, it is almost similar to annuity, to endowment or maybe term insurance, but that one articulates that the person will be given compensation if he doesn't die at the end of each and every year, and if he dies, the beneficiaries shall earn compensation. And the last one was statutory scheme, which requires any government officer and also some individuals who might opt to certain schemes to pay some amount of money. And of course, this money is usually being cut from the salaries. These statutory schemes include things like NHIF and also NSSF, whereby, for instance, the NSSF calls for an individual employed by government is usually being cut certain amount of money, and that money shall earn him compensation upon retirement. That is, maybe someone might have a salary cut of maybe 500 shillings per month, and when he gets to maybe the age of 65 and get retired, then there is a certain amount of money which will be earning. Let's say, for example, 10,000 Kenyan shillings, 5,000 Kenyan shillings, and so on and so forth. And for NHIF, you pay certain amount of money to NHIF, National Health Insurance Fund. Let's say, for example, the non-employed people pay 500 shillings per month. the employed, some pay 900 shillings, some pay 1,300 based on your salary. Then upon getting sick, you will be treated in all NHIF accredited hospitals. I want us to look at the last thing, the last sort of today, and that is characteristics of life assurance policy. Characteristics of life assurance policy. How do it look like? How does life assurance policy look like? Now, here we'll be looking at different characteristics of each and every type of life assurance. We had seen that life assurance is not just a single assurance or insurance, but there is different types. So when we'll be looking at them, when looking at characteristics of life assurance, will be so much diverged. And now, the first characteristic of life assurance is that it may cover life until death, as in that one of life, whole life assurance, or maybe during certain period of time. For example, in endowment, or maybe endowment takes some period of time, it can expire. There is term and also term assurance, which maybe can take some period of time, not until someone dies. The second one deals exclusively with life. So when you are taking life assurance and then you lose your property, then there will be no compensation. It is only it all deals with life. Maybe if you die, the family, or maybe of course the beneficiaries shall be given the compensation. And if you don't die, and maybe it is maybe annuity, then there is amount of money which will be given each and every at the end of each and every month. Then number 3 characteristic is that it is usually long-term contract. So let's take an example of whole life assurance. The whole life assurance usually takes requires the assured to be paying certain amount of money until he dies. So you will not require to do what? To do regular renewal, as in the way we'll be studying on general insurance, whereby one will need to pay certain amount of money or to renew the insurance at the end of each and every year. Like the way, for example, if you have a car, you have to renew your insurance cover each and every year. But for whole life insurance and other types of life assurance, you'll not be required to renew it, because your life is there forever. So and until you die, so you'll not need to do renewals. Number 4 is that its value depends on ability of a person to pay. If maybe you want to pay 500 shillings and you are in a position to be paying 500 shillings as a premium for your life, then you'll be paying only that 500 shillings. And if you are in a position to pay 10,000, then it is okay with you. So even when it comes to calculation of premium, it is the insurance company doesn't dictate how much you're supposed to pay, because it depends with what the assured wants to pay and what he or she is able to pay. Number 5 may be used as a security when acquiring loans. So let's take an example of something like endowment insurance, of which when you fail to die, you may put it like that. When you fail to die, there will be compensation, and that compensation shall go to who? Not the beneficiary. It shall go to the assured. So in case you want to take some loan from certain bank, you can use the endowment policy plan from insurance to present to the bankers. So they will be seeing that at least you have some amount of money in your account, and you are usually using that amount to pay for life assurance. And so they may just opt to give you loan, because they know that in case you don't die, you'll get money from the endowment life insurance policy to pay them back. Then another characteristic is that the policy can be assigned to the beneficiaries. The money which you are putting there, you are saving there, can be given to the beneficiaries. I'm very glad to get to the end of the topic. If you have a question, you can hit on my WhatsApp number there, or maybe on the comment section. I'll be glad and I'll be so much ready to answer your question. Thank you.